Welcome to another special Life in the Day of C19 podcast here at the Real Estate Crowdfunding Show, syndication in the digital age at GowerCrowd.com. Adam Gower here, and I am going to do something I never usually do, and that is date stamp this episode. Normally I like these podcasts to be evergreen, but in the day of C19, that is just not possible. Things are changing so frequently. So today's episode with my guest, Peter Fischer, who is a partner at the law firm Sklar Kirsh and one of my commercial real estate clients' attorneys. That's how I met him. Well, the podcast was recorded on March the 29th. 2020. Right now I'm recording on March the 30th. We're going to try and get this out by end of day March 31st. My team is on overdrive getting these incredibly important podcasts out to you with tangible, immediately usable information. And today what you're going to be hearing about from Peter is how to handle the inevitability of tenant negotiations or landlord negotiations, escrow negotiations, etc., etc. What is going to happen on April the 1st when all of these deadlines, the first deadlines since this crisis really began, or the first of a month, as I said in an email this morning, hits us. Peter very kindly spent some of his Sunday with me to explain the ins and outs of the legal landscape as far as tenant-landlord relations across the commercial real estate industry. It's absolutely fascinating and very important guidance for you today. There are masses of resources available to you at GowerCrowd.com. You'll find how to upgrade your home office so you can retain a professional demeanor even online. A guide for crisis communication is probably the most important thing you will read all year. We've put our flagship investor acquisition system online master course on sale at 82% off. So now's the time to get that while everybody is hunkered down. That will end after shelter-in-place orders have been lifted. It's all there on the podcast page and on the main pages at GowerCrowd.com. Do take advantage of everything that we've got. It is all there for you to use. Oh, and of course, you will also find links to Peter, my guest, Peter Fischer, and his firm, Sklar Kirsh, there on the podcast page at GowerCrowd.com as well. All right, let's not linger. On to Peter and his insights and guidance in a time of considerable uncertainty. What is going to happen on April the 1st? When all these rent payments and mortgages come due? Ladies and gentlemen, Peter Fischer, attorney, commercial real estate attorney at Sklar Kirsh. All right, so we're going to have a podcast. Life in the Day of C19 podcast number thing. I'm not sure what number.
As long as it's not 19.
It's not. Peter Fischer, real estate attorney at Sklar Kirsh. Thank you so much for joining me today. This is a very, very important day. Normally, I don't date stamp these podcasts, but these are exceptional circumstances. And today is March 29th, 2020, 2 days before the first day of the month, right? Since this really got very, very hairy. So with that in mind, I know that a lot of real estate professionals, commercial real estate professionals are wondering what's going to happen on April the 1st when all this rent comes due. So my first question for you is, what happens on April the 1st when tenants call in and say, hey, I got a problem paying my rent? Let's start at that gentle point of entry.
Sure. Yeah. And this is a fluid situation, right? It's changing day by day. New moratoriums and federal, regulations and state and local ones are coming. Hopefully both the tenants and the landlords have been talking before now, right? And we all expect, April 1st is the date when all of these defaults and rent, forbearances or forgiveness is going to come due. But hopefully everybody's been talking already. We at Sklar Kirsh have been advising our clients to communicate even before they have to. A lot of our landlords have sent their tenants notices about initiating, procedures about how they're going to handle the situation, seeing, putting in place procedures for who can pay, still, and who actually needs the help. But I do think you're right. I think we're going to start to see both, projections. All of this is going to start coming into effect and hitting, starting April 1st.
So you said something very important there. There's two terms. This is what I'm particularly fascinated with. First, let's talk about the difference between deferral and forgiveness of rent. And what are the actual, my understanding of it was that it is actually deferral. It's like, we won't charge late fees.
Yep.
We just, you'll owe us later, or payment programs, whatever. Tell me a little about what you're seeing out there.
Yeah, and I think that's a very important distinction, right? For the most part, this is not rent forgiveness. It is deferral forbearance is the official word, and that means, right, that it's eventually going to become due, and it's just a matter of pushing out those payments. So it's great to do that now, but I think both landlords and tenants have to be wary. In 2 months, 3 months, whenever things get going again, it may come to pass that there's whether it's May, June rent due, and then a portion also of what's been deferred. A lot of banks and landlords, you're seeing probably 90-day deferral, but then maybe that's, paid out again over the next 12 months thereafter, let's say. So it is not, at least so far, there's no rent forgiveness. This will become due, on the back end in one shape or another.
Okay, and so what's happening now is that folk are negotiating these terms, are they, Peter?
Yeah, and that's right. And banks, have their own terms that they're negotiating. Obviously the agencies, Fannie and Freddie, are giving, as I said, 90-day deferrals for their clients, but that's only if on the back end, those landlords are deferring any evictions for that same time period. And there's, again, it's very fluid. There's federal regulations, there's state regulations, there's county regulations, and there's also, bank by bank regulations. So all of these things are being looked at, and, clients are looking at the regulations, but also pulling out their loan documents, their leases, and everybody's calling, whether it's tenants vis-a-vis landlords or borrowers vis-a-vis their lenders, and we're deluged all day long with clients wanting to know one way or the other, what to do.
Is anyone adding it to the principal balance? Is that anything that you've seen?
I haven't seen so far it has been added to the principal balance. I've just seen, for the most part, it's been deferred and on the back end. I do think, though, after April 1st comes around and people start seeing the real effect. So far, it's been theoretical. They think they know what's coming. But it is going to be interesting, especially if it goes on longer than people have thought, to see the practicalities when these start to come into effect of, how are they going to be handled? And I do think, right, so far it seems like people want to work together. I think, there's a human element, right, to this. It's not just a recession. People are, there's physical ailments and sickness. But we'll see, once this starts to come into play, and people start feeling the pain, so to speak, right? It's, what is actually going to come into play and happen.
And how are tenants, or how are landlords determining whether or not it's a legitimate call, for example? I don't mean to suggest anybody's gaming the system, but how is that being played out? Yeah.
Right, and unfortunately, I think, right, that there will be at least a small portion of people who try to take advantage of the situation. But there, various landlords are putting in various procedures and policies, and proof of where employment, proof of, I don't know if any landlords yet are asking for, personal financial statements, but they are asking for information on, proving that you have, filed for unemployment, prove that you are, work at X restaurant and you can no longer go to work. They are asking for information because, look, if you're like me, you have a job where you can work remotely, you shouldn't be taking advantage of this and not paying. On the commercial side, it's a little easier, I think, to tell, because if you're a restaurant and you're mandated to close, you don't need much more proof, right? I mean, sure, you can maybe do some takeout or what have you, but and we can talk about this later, but retail, right, and hospitality, those commercial wise are the hardest hit, and I think that's where the biggest issues are going to be.
Interesting. And then good, so I actually asked the question with office in mind, but you pivoted to multifamily, which is of course something I'm very interested in as well. So what difference are you seeing, or how are different sponsors in different industries handling it, right? You've got the residential, commercial, real estate, residential operators, and then you've got the office, primarily these two major, and then obviously retail and industrial, but those two major ones. So what are there different processes going into place? How are they handling it differently?
Yeah, I think the asset class, really comes into play. I mean, if you're a multifamily operator, yes, you are going to have tenant defaults. I think I've heard, numbers. It depends on the area, of course, but people are expecting 25 to 30%, let's say, and and that's probably C class type, working class type apartments. But if you are a landlord of a retailer, or a Subway, let's say, you're going from full rent to zero or close to zero. So, we represent landlords and tenants. We've been proactive. The tenants have been sending letters even before everything was shut down, saying, we're just letting you know if we are forced to close, we're probably going to say this is a force majeure event under the lease. Landlords, we have some tenants with the Irvine company. They proactively have told their larger tenants that they're going to work with them. Similar to, what I've been talking about on the multifamily side, they're, deferring rents for 3 months and then paying it back over the next 12-month or 18-month period. And they're obviously one of the larger ones, and they can, afford and they're better able to work with tenants. But I definitely think it depends on the asset class, for sure.
So in multifamily, how does that work? A company can agree to spread out rents over 18 months. If you've got a tenant that is on a month-to-month, for example, or coming to the end of their first 1-year lease, you can't really negotiate those kinds of terms. So what are you seeing on multifamily?
Yeah, and multifamily, I think residential-wise, right, they're being affected more so by the federal mandates, the state mandates, temporary halts and moratoriums on evictions. And the landlords are trying to work with them, but they're in a bind as well, right? Because they have, obligations to the banks and debt service and, coverage ratios. But it does seem like, at least vis-a-vis landlords and tenants, people are, again, with the human nature aspect of it, trying to work together. Not always the case with, buyers and sellers of properties and banks. But I think that everybody understands that, the tenants are going to be, especially again in the working class, they're restaurant workers or what have you, and they're really going to be feeling the pain. And landlords, I think, are, for the most part, amenable to working with those folks.
Okay, so you've used the term force majeure. Majeure?
Yes. Force majeure. Yes.
I think it's must be an Irish expression.
It's officially French for superior force, I believe.
So now this presumably is a term that is used in commercial leases, not in residential leases, I'm guessing. So tell me something about what this term means exactly.
Sure.
And then let's talk about material adverse changes, which is
Yep.
something we saw during the last time downturn. And what's the
Sure.
similarity between these two things?
Yeah. So yeah, it's found in a lot of commercial leases, a lot of other commercial contracts, and it's usually seldom used, right? I mean, what it is if it's a flood, sometimes terrorism strikes, or depending on the drafting, epidemics, pandemics, right? And it is a force that is beyond the control of the parties that causes them not to be able to perform under a contract. Now, typically it's found mainly, again, as you said, in leases, sometimes in purchase and sale agreements, but not as much because they have casualty and condemnation and other provisions that are similar. But again, in that sense, they would cover physical damage to a property, which would excuse a purchase, but usually, right, not something like this, which is there's no physical damage. The property's still there. It's just a big effect on the economy and jobs and people's lives. So that's sort of force majeure. It's there's an event that occurs that is beyond the party's control, the contracting parties, that sort of excuses the performance under the contract.
So whose benefit is that usually oriented to? The tenant or the landlord, or is it somehow reciprocal?
It could be both. Usually it's in favor of the tenant, or a lot of times you'll find it in construction contracts in favor of the party who's doing the development, the contracting, and then paying for it. But it could go both ways, right? I mean, imagine if you are a construction lender, do you want to be continuing to put out draws of construction loans when you don't know what's happening in the market? So it could go both ways, but it is, I think, most typically thought of in the case of like large commercial tenants who have the obligation to pay, tens of thousands or hundreds of thousands of dollars in their lease payments, and suddenly, they're forced to close and they just can't operate.
Okay, so that's yeah. So that is the clause in a contract that attempts to account for these kinds of circumstances.
That's right.
How is it actually being used? Are people saying, well, hey, look, I've got this clause, therefore I am not paying? Or you've alluded to this idea that people are being accommodative of each other because it's such an unusual circumstance.
Yeah.
Are clauses being negotiated specifically as definitive direction for how we're going to resolve this problem?
Well, it depends on the case. It depends on the document. Again, in leases, and it also depends on how the particular clause is drafted. I think when you think of a force majeure clause, a lot of people who, just put them into the contracts and they're boilerplate, they cover, terrorism and floods and hurricanes. Most of them probably are not specifically tailored to pandemics and epidemics, although I can guarantee you that they will be now going forward. But yes, so in particular in leases, as I said, even before this all started, or at the beginning, right? Tenants like restaurants and retailers were sending their landlord letters saying, look, we recognize this is nobody's fault, but if we are forced to shut down our operations, we are going to be, calling on this clause, but let's figure out a way to work on this, right? And courts have often said, even if you're going to invoke these clauses, you have to put, people on notice, and you have to attempt to mitigate it. So here, maybe yes, you can do, if you're a restaurant, again, you could do takeout or, make partial rent payments, but if you're forced to shut your doors, there's not a whole lot that you can do unless you're, a specific kind of restaurant and you have a large takeout type, a business or something else. On the purchase side, the purchase and sale side, very much less clear cut. And, we have a lot of buyers who are either trying to get out of their contracts if they're past the contingency period, or maybe trying to get a price reduction, or in some way use the concept of force majeure, in that sense. But typically, those kinds of agreements don't have force majeure clauses. They have condemnation or casualty. And so we're making, and lawyers like us are making all kinds of creative arguments like this is a temporary taking, but it's harder because, they haven't shut down your multifamily property, let's say. But maybe there are, reps and warranties on how, and this is something that will come up on April 1st as well, deliverables of projections that you have told the buyer. Well, now you're going to really find out if those are, holding true. So if you haven't closed yet, that may be something else. Or
right. And you get one last, you get one last look at the books, 5 days before closing.
Yeah, if you have a well-drafted purchase agreement that says your reps are remade on the closing date, that potentially could be helpful. Or there's often conditions that from the period of the end of the contingency period through closing, the seller has to operate in the normal and ordinary course of business. Well, you probably can't do that anymore. So that's another possibility. But again, this is uncharted waters for everybody, and these are the types of arguments that we're trying to make on behalf of our buyer clients. And of course, sellers are saying, well, no, this property is still available for you to buy. There's no specific force majeure language, so it goes back and forth.
So the term that I saw being used a lot during the 2008 crisis, and I remember it primarily on the bank side, was this idea of material adverse change that really meant nothing when you read through the contracts until there was a massive collapse right in the system, and then all right, this will work for that. Is that something that you're seeing used, or was that
to a certain degree? Yeah, but you're right again, right? It's on the bank side, a default, let's say, for the borrower if there's a material adverse change. And what does that mean? In the last 5 to 7, however many years when we've been on this incredible run for real estate, it's meant absolutely nothing. But again, as you said, in 2008 and probably now, there's certainly changes that are material and adverse, and they're often in the bank's favor or in the landlord's favor. And so those parties are certainly looking at those types of clauses. But again, they have to work with their borrowers or their tenants because, the last thing that they want to do, and as happened in 2008 when there were a whole bunch of foreclosures and banks didn't know how to, operate these properties. And so, I don't think banks are in the shape and lending like they were back in 2008. So I think that's another reason that it seems like, along with the human element, folks are trying to work together, and stretch out the rent payments, and put them on the back end, or, that kind of thing.
Right. And there's been a little bit more federal support as well of banks this time, hasn't there? That
absolutely.
They're not being arm twisted into marking assets to market and recalibrating or reappraising everything, and et cetera, et cetera. Tell me something about that, why it looks a bit different from last time.
Yeah, and I think that a lot of that has to do with the fact that the banks are not in the shape, right, that they were in 2008. This is not an environment where banks were just going crazy anyway. Banks were much tighter. There's Fannie and Freddie, the agencies. There's a lot more relief. There are some, we have some deals where debt funds, that are not bank specific. They have had difficulties, they've run out of money or have a moratorium, especially until April 1st, right, when we start seeing what's happening. But I think the banks generally have been in better shape. They are looking to the federal government to have, the support if they in turn are supportive of their tenants. So it doesn't seem like, at least from that aspect, we're in the same kind of situation as 2008.
So you've actually mentioned a couple of things here that are quite interesting, which should probably leave till right at the end. But I'm going to interject this now. We were going to talk, you mentioned in our pre-podcast correspondence, distress funds, but well, let's get to that right at the very end, because that's kind of an interesting topic. We're still so early. But in terms of debt funds, there are some debt funds that are, as far as I've seen, that are underwritten specifically with the, not intent, but with the idea that if the borrower defaults, they would be very happy to take the asset at their basis. Are you seeing any aggressive pushes along those lines to take assets?
I have not seen that so far. And again, I think people don't fully understand the effects. Once we get into April and May, we'll start to see that. But I do think, again, this is not just the economy as we had in 2008. It's a human health issue as well, and I do think that has changed people's sort of view about, at least so far, right, about working with each other. We have clients who are both, like you said, they're debt funds, but they are operators and they have the ability to take over an asset and manage it at least until they put in another operator. But I haven't seen, at least among the folks that we have as clients, people who are taking advantage of that as of yet. Now, if this goes on,
presumably there's nothing. Yeah, I was going to say, because presumably nothing's past the point of being uncurable anyway.
That's right. That's very true. That's very true. Yeah, we'll see as time goes on. And again, in another 2 to 3 months, we'll probably have more federal regulations and stimulus, on the other side. But we'll see what happens.
So tell me, what are you seeing? Let's get back to some of these questions that we did tee up, and not to stay too off, not off topic, but on these fun questions that I'm interested in asking. But one of the questions that we talked about was, what are you seeing if somebody is in escrow and their money has already gone hard? So you've already talked about, you've touched on that, but drill down. I know you've got a few points that you wanted to mention on that.
Yeah, so this is a really interesting situation, right? I mean, we had sort of leading up to this, I had a client with 4 active deals, going gung-ho, 2 different lenders, equity partners, right? And this has obviously hit all of these participants. So we've seen everything from, buyers in escrow, and if they're not past their contingency period, I think most buyers are just, pulling out and waiting to see what happens. But once you've gone hard, again, where, making all these arguments of force majeure, temporary taking, common law provisions of, impracticality, frustration of purpose. So it's really become kind of a letter writing campaign and crafting arguments to figure out how you can, and not all buyers, right, want to get out. Some want a price reduction, some want to extend the escrow period 60 or 90 days. And absolutely, again, it depends on the asset class. I think you won't find any buyers who are going into a hotel deal who want to do anything but just get out of the deal. Whereas on the multifamily side or self-storage or, in other asset classes we deal with, that's not the case. And in some of these deals, the banks are the ones who are coming in, banks or debt funds, lenders are coming in and retrading, upping the interest rate, demanding more, longer, interest reserves. So that then affects the borrower and how they need to react, and the seller also, maybe the seller is in a 1031 exchange. So these are all, different permutations of things that we're seeing. But certainly there's anything from help me get out of escrow to, we need 90 additional days or a price reduction or any combination of those.
It's interesting that you say that banks are the ones that you're finding are retrading, particularly as interest rates are historically almost not quite as low as they possibly go, you would think actually that this was a very good time to borrow. Tell me what that's all about. Are they trying to get out of these deals by doing that, or are they profiteering?
No, I mean, I think the banks are skittish like anybody else. And, the banks are pricing the risk into the market. And the first thing they would do is put in a floor on LIBOR, so that doesn't run away. But then, they would use all of these same arguments to say, look, your interest rate was at, 3 something. But in order for us to do this deal, like this happened to us, the banks went up to 5%. This is a non-agency bank, not Fannie or Freddie deal. And again, it's also very much happening with the non-bank lenders, right? The debt funds who are running out of money and are
That's
finding
interesting,
ways. Yeah.
Peter, though, but it's interesting that you say that, because it seems to me that either the situation is so dire that you don't want to do the deal, right? That it's, let's just stop and wait. But to increase the price it's a different approach. Are you building risk into it? Because is that what's happening? I mean, it's taking a larger spread, or is it we're going to try and put this so out of reach that you back out? We really don't want to do this, but we're not going to say that.
I don't think so. I mean, we certainly have had lenders, and actually one of the deals, two of the deals had the same equity partner, and the equity partner did just say, we're out. We don't know what's going to happen. We're just hitting pause. I do think from the bank side, unless you're one of these debt funds who's out of money or something, I do think it's about risk. And I think the banks, at least so far from what I've seen, they want to do deals. And there is still liquidity, but it's, a slightly different profile right
now. What asset classes, I'm interested to know, are holding up better? If you were to put them in a kind of a best to worst, and any surprises?
Well, the worst obviously is retail and hospitality. One surprise has been, so I don't do a ton of residential, but I'm working on one very high-end single family, or actually it's a 2-parcel property in Beverly Hills. And that deal has had the same type of issues from our side of, equity partners backing out, this, that, and the other thing, and we're so far working with the seller. But we've been able to present the seller with some good news that 7 homes in the last 10 days have been closed in the, call it $25 to $45 million range in that area, which is very surprising, right? I mean, there were, no face-to-face listings, right? You can't go do property tours. But I think a lot of very wealthy folks want they want a sanctuary. And so there's actually sales of single family homes, and particularly I think high-end homes, that are doing all right and reasonably well. And frankly, in the back end of this, I think, there may be a flight out of density, people who want a little bit more space. And so I think the residential, particularly high-end residential market, probably will be okay at the end of this. I think self-storage, other types of assets where there's not a lot of face-to-face, the rents and storage are not, that high. A lot of them are on auto pay, right? So it may be a while before people who lose their jobs and have to save money realize, hey, this is getting withdrawn automatically from my account. Whereas high traffic, high touch hospitality, retail, all these other asset classes, I think are going to be really devastated.
What about multifamily lease-up rates? I've heard anecdotally that there are spikes actually in that. Is that something you've seen anywhere?
We have had reports on, with one client of the lease-up rates going up, but I think come April, we'll actually see, what happens. And look, people need a place to live, even if they've lost their jobs, which is, one of our clients is a big mobile home park operator, and they think that they'll be in fairly good shape. But at the end of the day, if the job report was what 3.3 million unemployment, twice what people thought it would be, and it's not going to get better maybe before it gets worse. So I do think that even in these residential type multifamily mobile homes, there'll be issues there as well.
So one of the comments that you made in your email to me was that buyers and sellers, real estate investors, are optimistic, and that nobody's really acting as though this is, quote, the end, right? The music has not stopped. It's stopped, but it's just on pause. We're just waiting for it to come back. So that's really how people are acting, you think?
Yeah. Well, I mean, if you look at the public markets, right, down what, 35% in 2.5, 3 weeks, that's not happening in real estate, in private deals. I mean, in pricing, right? I mean, it's, properties have not declined by 35%. Now, right now, it is very difficult to get a deal done. But it is not the case where and I think this is, again, a difference, at least at the moment with 2008, there's not massive amounts of single family homes that are, in Vegas or wherever that are 30%, 50% off of the price that they were previously. And, I do think like we're getting some calls for distressed debt or distressed funds to be formed, but, there's not this mandate and I don't think rush to sell, right? If sellers are on pause and their properties are down 10%, I do think that people think in another 6 months or, another 2 quarters, prices, and deals will come back, right? It's not like people's properties are down, portfolios are down 50% on the private real estate side so far. I haven't seen that.
It's just made a 5-year deal into a 5-year and 6-month deal.
Yes, and maybe a 6-year. We'll see.
Right.
But so far, right? I mean, the prices have not plummeted like they have. There's no crazy bargains like in the public equity market.
Yeah, other than REITs, maybe.
That's right. But I mean, in individual private real estate assets, I don't think, at least the multifamily properties and the mobile home parks and self-storage facilities, we've not seen anybody saying, wow, this is, other than the buyers, right, who are trying to figure out what to do in escrow. Again, look, lots of people in the last 5 to 7, however many years have made lots of money and they have it and they need to deploy it. We had another call, a partner of mine with a client who has 2 funds of $600 and $800 million, and they are thinking, okay, we've got all this dry powder. It's going to come to pass in 3, 6, 8 months that there's going to be assets to buy. So I don't think people are thinking it's the end. I think people are, again, hitting pause and trying to make sense of everything and seeing what stimulus comes and what regulations come down. But there will be a time when there's deals to be done again.
Interesting. Yes, it is a different feel from the last time, isn't it, Peter? Very much so. When we're looking into the abyss of financial collapse, seems to have, it's so unnatural that it seems more like a bump, obviously a really tough bump, but bump nevertheless in the road, and we're still headed in the right direction.
I think that's right. And I think, the last time when the banks were lending, no doc loan, I mean, it was real estate related or real estate caused, right? I mean, this is not that. So I think the real estate markets, the banks, I think the players generally are in better shape going into this than they were in 2008.
So you did mention opportunistic deals. Let's just wrap up with a couple of questions.
Sure.
Folk are looking at putting together distressed deals or distressed deal funds in anticipation of some failures, right?
That is correct. We do have clients who have called about that.
So what are you anticipating are going to be the areas that will yield those kinds of opportunities? specifically?
Yeah, I mean, I would be surprised if people come out of this and want to jump back into retail and hospitality. I mean, obviously there will be assets, I think a big decline there. But if you think about it, when it's safe to go back to work, are people immediately going to want to go back to a crowded restaurant or a concert or a basketball game? So I think maybe some folks will be looking at those kinds of assets, but I think probably more in the office, or if there is the mom and pops who have been forced to sell their multifamily. It's hard to say. I think a big area where there will be some opportunity is in the restructuring funds, or sort of the bridge loan kind of thing, where there will be a period where restaurant owners and these people will need to restructure and need some help getting back on their feet, but eventually will recover. So it'll be interesting to see whether it's actually buying assets, or on the lending side of lending support to some of these other industries.
That's interesting. All right, so let me wrap up with two final questions, kind of the same question, but for two different audiences. What is the hardest challenge? Sitting here again, I'm going to try as hard as I can to get this out before April 1st. I've got 48 hours. Let's see if I can get my team, who is already backed up to the hilt with stuff to work on for me, but let's see what we can do. April 1st, what's going to be the hardest challenge that a multifamily operator is likely to face, and how should they handle that? And then let's ask the same question about office. I imagine it's the same, but maybe some nuances.
Yeah. I mean, and again, it is dependent on location and dependent on sort of asset class, right? I mean, working class renters versus, folks like me who are, in a Beverly Hills condo. But the hardest thing is going to be suddenly when all these defaults and all of these, people start calling, and then you have in your other ear, the bank, your lender's calling you. And in the meantime, you're pulling out your leases and your loan documents and trying to figure out, where am I going to be in default with my lender? What do my leases say, and how am I going to work out, this situation when suddenly 25, 30% of my tenants are calling me saying, I've lost my job, I can't pay the rent. And as far as what you should do, again, hopefully you've already put this into play and been in touch with your lender and been in touch with your tenants, because that's really, again, the communication and putting these processes and sort of filtering out, who can pay, and communicating, I think, again, on the human level with your tenants and saying, look, we are here for you, we're going to offer you assistance, but only if you need it, right? And then also going through your loan documents with your lawyers and your advisors and seeing, what are the ramifications if I really do have 25 or 30% of my tenants who default, and let me, preemptively contact my lender and start having that dialogue. And I think it is, right? It's the same on the office side. Whereas people like my firm, let's say, where we're all working remotely, we have business interruption insurance, whether or not, the insurance companies accept a claim or not. But at the end of the day, most likely there will be some nationwide or statewide litigation where some of these claims start to get paid. And maybe some renters on the multifamily side have renters insurance, but I don't think, those policies are bound to cover something like this. So while, some office tenants, law firms, big financial firms probably are more likely to be somewhat operational and weather a storm, I still think there's going to be at least some percentage of those folks who are doing the same as, multifamily tenants.
Yeah, Peter, a lot of brain damage, a lot of hard work and stress still to work through. There's no doubt about that.
Oh, right? I think it's closer to the beginning, unfortunately, than in the end. But again, hopefully people are, still willing to work together and, have these conversations and work out the kinks.
Peter Fischer, Sklar Kirsh, thank you so much for your time with me today. Maybe, if you are willing, maybe we can revisit in a month and see. It's entirely up to you. Maybe we can
absolutely
do an update and see how things are changing.
Curious to see a month's time how this will happen. And I thank you very much for having me. Enjoyed it.
Yeah, my pleasure. Thanks for joining me.
Thanks a lot.
All right, that was Peter Fischer in these extraordinary times of Sklar Kirsh, explaining exactly what we have no clue is about to happen. Basically, oh my goodness me. Hopefully Peter will actually take me up on the offer to join me again at the end of next month so that we can actually reflect upon what has happened and how things are unraveling. Hopefully not unraveling, but staying together and remaining cohesive as we move through this extraordinary period in all of our lives. Anyway, that's it. Don't forget, go to the podcast page where you will find some incredible resources, including a guide to crisis communications, how to upgrade your home office, a bunch of other podcasts that are right on topic. For now, 82% off our flagship investor acquisition system, online master course, really everything is there at GowerCrowd.com on the podcast page. Take a look. I think I have over 1 million words on that website. So there's a lot of content for you there, and a lot of it pertinent to today's coronavirus crisis. That's it. Thanks so much, Peter Fischer, attorney at Sklar Kirsh. Really, really appreciate you spending some of your weekend with me to record this invaluable information today. And thank you also for joining me today to listen to Peter speaking. Really appreciate you taking time out of your day as well. That's all for this episode. I'll see you next time. And for now, stay well. This is Dr. Adam Gower signing off.